Welcome to the Women in Wealth podcast, brought to you by Regina McCann-Hess, a certified financial planner with over 2 decades of experience. This show is for professional women who want guidance in working towards their retirement vision in learning, building, planning, striving for your dreams, and putting the work in now so that you can pursue your financial independence.
Wait, I thought the stock market only went up. Why is my statement down this quarter? Hello, I'm Regina McCann-Hess, president of Forge Wealth Management, and welcome to our Women in Wealth series. Today, you can guess what we're going to talk about, market volatility. And that is not something that we, have grown accustomed to be a normal everyday event because the markets have been very kind to us over the past, actually several many years. But we have experienced pocket of volatility. But as with other things that are painful, our minds tend to forget the painful parts, right? So we are experiencing stock market volatility. And like I said, it's a normal part of the experience. It can't all just go up. We have to have some, resets there every once in a while. And for many different reasons, you have stock market volatility. Um, so what does that mean, stock market volatility? Well, the market's, up, down, up, down. It could be down. It could be down for a couple of days. But your statement values will look a little bit different than last year. And if you remember, last year, I think it was like March, April of 2025, we also had a bout of volatility. And people were starting to get nervous, like, oh, wait a minute, the stock market, I thought it just went up. Why is it down? There's many, many reasons. Right now, the stock market's been, acting out, or so to speak, because of all the skirmishes going on around the world, in particular, Iran and the United States. And the stock market does not like things like that. But it is also normal for the stock market to have reactions to everyday events like military action across the globe, like extreme things happening in the world. There's fear and anger that drives the market, in addition to all the real reasons what drives the market, which is earnings, right? But fear and greed also can drive the market too. And people get fearful. They can see some more volatility. And you'll, experience that if you've been investing for a long time. You'll know that you've lived through many, many times when the market was really volatile and it was painful. But you've also lived long enough to know you'll get through it. And so everyone's experience is a little bit different in how they get through it and what their comfort zone is during that time period. But as part of being in the market, you do have to develop some kind of strategy for getting through the volatility. So it is part of the investment experience, and it is a necessary evil, I guess you could say. The market just can't go up. But you'll notice, if, like I've said, if you've been in the market for a long period of time, the longer you stay in the market or invested in your holdings or your portfolios, the better potential for an overall positive return. Obviously, on short time periods, the volatility is going to impact your portfolio more than long term. So if you're kind of looking at a picture of the stock market graph, it kind of, over a long period of time, it kind of looks like you're walking up a hill, right? But if you take smaller snapshots, it's kind of like a roller coaster ride. And as much as I love roller coaster rides, I don't want to see them too often or get on them every single day, because you get a little bit of whiplash for that. So, but again, you go into a theme park ride, you gotta ride a roller coaster, and that is part of also being part of the stock market. So, we are going to talk about 10 things you should know about stock market volatility. So let's put points into perspective. So the headlines sometimes bear news of, like, the Dow Jones Industrial Average dropping, and that can incite fear, because we're on 24/7 with the news, right? But it's all relative. A 1% swing at the year end 2025 levels was equal to 481 points. When the Dow was at 10,000 points, a 1% swing was only 100 points. So volatility is actually a matter of perspective. Where are you now? And what are the numbers that we're talking about? Okay. Okay. Point number two is there's an index for that. So there's something called the CBOE VIX index, and that's what we call nicknamed the fear index. So that measures the market expectations for volatility over the next 30 days. And the VIX tends to have like an inverse correlation to the S&P 500 index. So when the market's down, the fear is up and vice versa. So a score below 20 generally indicates investor contentment. A score above 30 suggests anxiety. All right. So let's move on to point three. Point three is the only thing to fear is extreme fear itself. I seem to remember a very famous president quoting a very similar quote. But the VIX score of 40 or higher does indicate an extreme fear among investors. Now, this does not happen very often. In fact, since 2010, the VIX has only spiked so high on 55 trading days. So that's a very long time period for it to hit that spike during that time frame. Okay, the fourth thing you should know is that you should not let bad days blind you to good days. So, since the VIX's inception in 1990, 60% of the days of extreme fear occurred in 2008 and 2009, which was the global financial crisis. And if you remember the global financial crisis, you do remember being fearful. There was a lot going on. There was a lot to be fearful of, but it was very, very scary. Now, most years, 26 years, as a matter of fact, since 1990 to be exact, did not see a single day when the VIX hit over 40. So historically, extreme fear has been the exception, not the rule. Okay, point number five. Volatility in 2025 was up, but not by much. Despite a year of heavy tariff turbulence, volatility in the S&P 500 index in 2025 was just about a percentage point less than the 10-year historical average from 2015 to 2024. Now, only 22% of the trading days in 2025 had actual swings of plus or minus 1%. So, while there was volatility, that's not a crazy amount of volatility with big swings. Okay, point number six, patience is a virtue. That's what we're saying. While investing in the stock market does have its ups and downs, and you should expect them, the longer an investor stays invested, the less significant the bumps in the road appear. So, as represented by the S&P 500 index, stocks have tended to be up more often for investors who hold on to their holdings for longer. Okay. Point number seven, no one said it would be easy. No one, no one. So from 1986 to 2025, the S&P index did return an average of 11.47% per year. And investors may have expected similar 11% returns in any individual year. However, there were actually only 3 years in which the index returned between 9 and 12% during that period. So volatility is much easier to tolerate it when you expect it. And obviously, if it's volatility on the upside, you're like, oh, okay, I can take care of that one. It's the downside volatility that I don't like. All right. The eighth thing you should know is that do you want to minimize your volatility? So, if market volatility makes you uncomfortable, you can work with your financial advisor to make your portfolio lean a little bit more conservative or add things that are like going to help minimize volatility, re-strategize your investments without abandoning growth-oriented investments. So that is something you do want to talk to your financial advisor about. The ninth item would be to maybe embrace volatility. Now, obviously, you have to kind of have thick skin for this. And if you're able to put aside the day-to-day discomfort of market volatility, it could provide opportunity for higher returns. Now, while trying to time the market is ill-advised, we try not to do that. Investing during down markets is exactly in line with the old financial adage, buy low, sell high. So where are you doing this automatically without even thinking about it? Your 401k plan, your retirement plan, if it's not a 401k, 403b, TSP, whatever the alphabet soup is, in your retirement plan, it's the best way to be doing it. You are every paycheck, hopefully, you're having automatic deductions to your retirement plan. And as the markets are down, you're buying more shares. So it's kind of like, when Nordstrom's has their half yearly sale, you're buying things on a discount. And it's really good for long term to do that. Short term, maybe you get that little high, like, oh, I got that on a discount. But it is very hard to do it on your own as opposed to just like, hey, it's automatic in my 401k. It's hard for some people to say, oh, the market's down and I want to go, add to my holdings. Usually people are running out the door, when the markets are going down and they're not speaking to somebody who's a professional and guiding them through that. They're like, oh gosh, I got to get out of here before it gets worse. And then, they never know when to get back in. So this is a great time to add if you have the stomach for it and you understand what you're doing and your long-term strategy. This is not a short-term strategy, obviously. Kind of like thinking about when firefighters are going into a burning building. And everyone else is running out. And the firefighters, of course, are heroes because they're taking care of everybody. But this is something that you can kind of like, oh, well, this might be something I could do for myself to help my long-term strategy. Doesn't mean you're always going to be right. The market still may go down, but if you're a long-term investor, it may prove to be fruitful later on down the road. Okay, now the 10th item on my list is that the glass has been more than half full historically. So if you're swept up in volatility, remember that markets have been positive more often than not. So in fact, stocks have turned in a positive return 68 out of the last 88 calendar years, which means that they've been on the rise for 76% of the time. Not bad. That's what I would say. Not bad. Obviously, in class, you went a little bit higher of a grade, but, there's a lot of things like we mentioned earlier that could impact the stock market. And you don't have control of everything, right? There's fear and greed, right? And you could potentially control your own fear and greed. But there could be a recession, there could be bad earnings, there could be, a whole sector that's underweight because of, like say it's pharmaceuticals and there was this one really bad drug and they all got pulled down as a result of it, or whatever condition is impacting that sector. You can't always control that. So you just have to decide on how are you going to strategize to handle it? What's your long-term goal? What's your short-term goal? And where are your, visions and your values corresponding with that? And how is it going to help you to make those decisions about, whether or not to ride out the volatility, or do you have enough cash so that you don't have to sell in volatility? Things like that are great things, conversations to have with your advisor well before the volatility hits. But if you haven't had that conversation beforehand, now's a great time to have it. Okay, so thank you so much. Again, I'm Regina McCann-Hess, president of Forge Wealth Management. My website is forgewealth.com, and you can follow me on Facebook, Instagram, and YouTube at Forge Wealth. And on LinkedIn, it's Regina McCann-Hess. Go make it a great day.
Thank you for joining me for this episode of the Women in Wealth podcast. You can watch the founders video I created for you to learn more about me and how I can guide you towards your financial independence at www.forgewealth.com. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Securities are offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Forge Wealth Management are separate entities from the LPL Financial. Our show guests and their companies are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management.